So kicking things off with a karakia, and for those of you that aren't sure what a karakia is, it's a Māori custom here in Aotearoa, New Zealand, and it's really a prayer invoking guidance and protection, and it's often said at the beginning of the gathering to bring about goodwill. So you can see on there's the English translation, but I'm going to read in Te Reo Māori. So te hui, whaia, te matoranga, kia marama, kia whai, taki nā mahi katoa. Tu maia, tu kaha, aroha atu, aroha mai, tātou kia tātou katoa. Tihei mauri ora. Great. Well, I just want to take a bit of time to introduce you to the three speakers today. So my name is Brigitte. I'm a senior consultant at WSP. I mostly work with clients all on their climate-related disclosures, scenario analysis, and also transition planning. I'm also joined by Matt Raeburn. Matt leads up our WSP Asia Pacific TCFD practice, and he also leads our climate scenario approach as well. Our guest speaker today is Jack Bessett. He is from the External Reporting Board. He's the policy manager there, and he works a lot within the XRB's implementation and guidance for strategy, scenario analysis, and transition planning. But I'll also note that both Matt and Jack have worked together previously at Ministry for Environment and were actually a part of the team that was implementing the legislation that is pushing this sort of work through Aotearoa. So they've been around in this area right from the beginnings of the work and now starting to see it actually implemented through that legislation, which is awesome. So the agenda today should be showing up on your screen. We are going to set things up, set the scene nicely. We know that there's a bit of a range with everyone that's listening in today. Some people work in this space and others are brand new to it. So we'll set the scene and talk through climate-related disclosures. I'll talk through a real-world example that we've been working with at WSP, a confidential client, but I still think a lot of insight that you can all get out of it and apply to your own business. And that example will be talking through steps to lead you to understanding how you might tackle quantifying financial impacts. Then we'll throw to Jack, and he'll be talking about the XRB's approach to this and how they're going to be implementing it and giving guidance through their standards. And we'll finish off with a Q&A. So with that, I might actually throw to Matt now to give a bit of an overview of climate-related disclosure.
Thank you, Bridge. Tina koto, ko Matt Raeburn toko inua. So I'm Matt Raeburn, Asia Pacific TCFD Climate Scenarios Lead for WSP. If you don't know what WSP stands for, that's okay. I don't either. A good mnemonic for remembering it is we solve problems, and that's what we're going to try to do today. I'm originally from New York, but based here in beautiful Wellington, Aotearoa, New Zealand. And as Bridge mentioned, I'm going to give what I think is just enough context about this, especially for those of you who don't know anything. We just want to give you enough background to be able to follow along with the process and the example that we're going to lay out. So this is first going to explain exactly what financial reporting is. What climate-related disclosures is. It is financial reporting to investors and stakeholders. That's it. You call it TCFD reporting generally outside of New Zealand. TCFD stands for Task Force on Climate-Related Financial Disclosures. That's the multinational standard setter. And as it says there, this is actually more of a strategic exercise in the guise of a reporting exercise. It's not about compliance. Unlike other financial reporting, though, the focus is on the risks and opportunities related to climate change and the resilience of an organization's strategy. And that's why we're saying that this kind of work supports the why, because it empowers each of your organizations to tell stories about your responses to climate change, where you are, where you want to be, and how you're actually going to get there. And at WSP, we deliver a lot for the built environment. This kind of work really supports our why, and that why increasingly will determine whether or not things that we provide advice on get built at all. And that's part of why WSP has committed to having the carbon footprint of our designs and advice by 2030. Now, I really like this kind of reporting because I think it is a strong lever for action on climate change. I worked on climate policy at New Zealand's Ministry for the Environment during the Zero Carbon Act period, along with Jack. And because this has the potential to meaningfully shift capital in New Zealand and globally, climate-related disclosure, I think, is much more likely to facilitate a transition to a decarbonized, more resilient economy that policies like the New Zealand Emissions Trading Scheme, which is well-intentioned, are being shown to not be effective at doing so far. Forgive me for a moment while I kind of take you through some acronym hell. But as I mentioned, the TCFD framework is this international framework that actually aligns with the Zero Carbon Act, which Jack and I worked on and passed back in 2019. And that Zero Carbon Act obligates the entire public sector and all of our lifeline utilities to report to the Ministry for the Environment and our Independent Climate Change Commission to inform their policy development. The Climate-Related Disclosures Act is what mandates climate reporting within Aotearoa, New Zealand. That covers about the better part of 200 organizations, banks, insurers, fund managers, and large corporates listed on the New Zealand Stock Exchange. That passed in 2021 and adopts essentially the TCFD framework. And as Jack will elaborate on, the External Reporting Board, XRB, is the standard setter that has developed these pioneering climate standards for New Zealand. The Climate-Related Disclosures Act also updated the Financial Markets Conduct Act, which is relevant because that is what gives our regulator the authority to regulate and enforce on these kinds of disclosures. So the FMA will be, over time, looking at the quality of the reporting, not just whether or not you're actually doing it. Now, separate to all this, there's been development of the IFRS, International Financial Reporting Standards, that has most recently been issued. The XRB had a bit to do with some influence on that, but that is probably what a lot of you who are international are going to be looking at. Apologize for the acronym hell. Let's try to dispense with that and actually, get into the task at hand and focus on what's really important. So this is how the TCFD framework at a high level lays out risks, opportunities, and describes how that feeds in. I don't want to talk about all that today. What we're going to focus on is just the financial impacts piece and getting to that.
So I'll jump back in here now. And so before we get on to understanding and quantifying financial impacts, there's actually two steps beforehand that set you up really well for that. So we're going to talk you through these steps along the way, and we are going to use a confidential client example to walk you through that. So our real world example is a international transit hub. They own and maintain infrastructure. They've also got quite a carbon intensive service. They've got key assets near the coast, so they're really exposed to physical risks of climate change, sea level rise, coastal inundation. But going back to that carbon intensive service, they're also really exposed to regulatory change, policy change, and changes in customer preference as well. So if we just focus on that first step for now, risks and opportunities, what you're trying to do here is really get a good handle, a good grasp of your priority risks and opportunities. So at that point, you want about 5 or 6, not many more, and you want to hone in on those key ones and understand what's really material to your business. Out of that, you'll be working then on your impacts and then moving on to working out what the financial impacts of those are as well. So you can see here for our client, we've broken things down into a transition risk example and a physical risk example. So transition risks are more about those risks you face in the transitioning to a low carbon economy. So they could be policy risks, market changes, anything like that. Physical risks are more the physical impacts of climate change, sea level rise, coastal inundation, and all of those sorts of things. So our client, one of their key risks was decreased demand due to the increase of transport costs and the changing customer preferences as well. And then over on the physical side, it was the storm surges that could cause flooding as well. Now, to understand these priority risks, they used a number of methods and approaches to working that out. They use GIS, geospatial analysis, to understand how exposed they were. They also did some desktop research into the speed of regulatory change across their regions. And they also ran stakeholder workshops that had asset managers from their business, subject matter experts to all comment on this, to give it a judgment call and do it in a qualitative way as well. Moving on to that second step, which is really understanding the impacts. And this is a really crucial step before jumping onto your financial impacts. The reason for doing that is that one risk can have multiple impacts. And then, as you'll see as I walk through this example, out of those multiple impacts, those impacts can have multiple financial impacts as well. And so you're trying to work through that whole approach to really get a full picture of what the impacts are to your business model and company. So you can see up here for our client, with that first risk for transition risks, you can see the decrease in demand and changing customer preferences spanning out into multiple impacts that could be an increase in carbon cost, fewer customers that can afford the long distance travel, but also if the company fails to meet emissions reduction targets, they could have that shift away from their service as well. They could lose their social license to operate. Over on the physical side, you can see that splitting out into multiple impacts. So this is more that they could have the site access restricted, a loss of operation for some time. They can have direct damages, and also there could be another one, which is actually having to face managed retreat and no longer being able to have their asset in that location anymore. So getting on to the next part, which is financial impacts. So this is a really key step within the XRB's guidance and also for TCFD. It's a critical step for investors, but also what we're really pushing here is that it's a critical step for using it as an internal mechanism to influence your board as well and get them listening and understanding the big risks that you face. So when you get down to this level, you're trying to start to talk about the impacts to your direct business model. So things like your revenue, expenditure, assets and liabilities, capital and financing as well. It can obviously be a bit daunting. I know that there's a lot of CFOs out there that are worried about this. They're not that keen on disclosing the numbers publicly, but definitely don't feel like you need to jump into quantifying straight away. You can absolutely start with in a qualitative way and just describing those financial impacts as well. So but before I get into the example, I just want to talk through if you are going to get into quantifying with your financial models, don't assume that you can just jump straight into your existing financial model and add in a few climate variables in doing that. So your existing model was designed for a different purpose, and the underlying assumptions that are a part of it won't align with those 3 climate scenarios that you're using. So those could be things like your orderly, disorderly, and hothouse world that you're looking into. So if you are going to go down the track of using your financial model, please start off with just understanding the underlying assumptions that are baked into that model as a first step, and then working out whether you can adapt that model, but it's more likely you would have to create a whole new model as well. Also really important to not completely outsource this work to consultants. You want to upskill your own finance teams. They're the ones that understand all the nuances within your business, and when it comes to communicating these things to the board, they're going to know the assumptions and everything that's in that. So walking you through our example, and I know this slide is super busy, but it's really just to paint the picture of you're starting off with that risk, you're identifying multiple impacts and then multiple financial impacts. So you can see here for the transition risk, it leads on to a potential stranded asset because they didn't transition fast enough, increased costs due to the carbon price, but also a loss of revenue due to fewer customers. And coming on to the physical risk, so you can see that kind of spanning out into loss of customers, loss of revenue, asset repairs, but also a stranded asset if it's leading to managed retreat. So our client went about doing this in a qualitative way to begin with, and they went through and identified this full spectrum of impacts. They explored what it could mean to completely write off that asset, and they worked with their finance team and asset managers to identify a broad range of figures for that, and used orders of magnitude to do it as well. And that's a really key part. Like, you can use orders of magnitude in doing this and give that broad range. Also really key as you're working through all of this is to note your assumptions and show your math. So just in a summary with all of this, start qualitatively. As you work through identifying all the impacts, you're going to know the expertise that's required through the process. You're going to be identifying parts in the business to bring into the project, internal and external. If you get into those financial models, really think about those assumptions that are baked into it. But don't feel like you need to spend a lot of time and money with adapting those financial models. This is an emerging field. We're also not trying to predict the future. We're just trying to bring about plausible climate futures to inform business strategy at the end of the day. So with that, I'm just going to hand over to Jack, who's going to talk through some of the XRB's work in this area.
Thanks, Bridge. Kia ora, everybody. My name's Jack Bissett. Great to be here on this webinar, and hello to everybody joining, particularly overseas, as well as in Aotearoa. I'm calling in from sunny Aotearoa, Christchurch. So yeah, great conversation so far. Really think this is an important area, one that's starting to come onto the radar of more and more people as they work through the climate standards here in New Zealand and obviously overseas as well. So yeah, I'm a policy manager. I work at the External Reporting Board, which is New Zealand's independent Crown entity, which has always been tasked with setting audit, accounting and assurance standards, and now more recently climate standards, after Matt and I managed to convince them to pick up the baton and do some work in this area, which has been something that the organisation's really embraced, and now much more people know what the letters XRB stand for. So I'll just talk to three key messages on financial impacts and try and keep my remarks brief, and then keen to help answer any questions that are coming through. So three key messages from the XRB on financial impacts is basically number one, don't forget the why, and I'll run through a couple of slides on the sort of bigger picture context around this whole area. Just something that we do find people get a little bit lost in the weeds of doing this sort of quite complicated and novel analysis, and keeping in mind the bigger picture on why it's important and where you're ultimately trying to get to. Super important. Number two, as Brigitte started to touch on, financial impacts can be expressed as ranges. There's a lot of uncertainty that we're grappling with here, and more than usual. So starting in broad orders of magnitude and as much as possible, a good solid qualitative understanding is very important. And then last point will be, take care when judging whether to quantify, and Bridge was starting to talk about some of those, the need to go relatively slowly around things like using existing models. So number one on the don't forget the why, I thought I'd start with the Intergovernmental Panel on Climate Change and the sort of the very big picture why here. So, we're trying to answer the question today, what could climate change cost your company? Well, there's the potential that climate change is going to cost us as a human civilization. It's not just about your company, as important as that may be. It's also about us coming together to raise our ambition and basically avoid the worst consequences of climate change, and to secure a livable and sustainable future for us all. So there is a important broader context here, which is raises relevant questions here, which is if climate change could have potentially catastrophic impacts for the planet and for human civilization, then what does that start to look like for your company. Moving down to the why, which is in the enabling legislation, and then this is a quote from our the purpose statement, which is in our climate standards on the left-hand side there in the call-out box. So the ultimate aim is to support the allocation of capital towards activities consistent with a transition to a low emissions and climate resilient economy. And when we say allocation of capital, we are meaning both external capital from investors, but also internal within your organization. So that's the next level, which is also important. And then just moving on to the strategy section in particular, which is one of the 4 pillars of the climate standards and also the TCFD framework. So we have this disclosure objective, which is also important context around the why. And I won't read it out in detail, but effectively, primary users are looking at these disclosures in order to understand how's climate change currently impacting you, how may it do so in future, and then skipping to the bottom there, what are you doing in response to position yourself strategically as the global and domestic economy transition. And then, just to finish on the nature of this being a strategic exercise, which Bridge and Matt both mentioned. This is a quote from the basis for conclusions that sits at the back of our standards, which is trying to emphasize this point that there is a need for entities to really reflect on their current business model and strategy, and to really test themselves and ask the question about whether or not they consider that they will need to transform themselves to become more resilient to a broad range of different climate outcomes that we could face, from the globally ambitious 1.5 degrees and the emissions reductions that assumes, through to the runaway climate or the catastrophic climate impacts into the spectrum with 3 degrees or greater of climate change. So that's plenty on the why. Moving on to our second key point, which is that financial impacts can be expressed in ranges. And as Bridget said, it's important here to sort of build a solid starting point, which is largely qualitative and includes an understanding of the underlying work that's gone into those risks and opportunities identification and assessment, and then also the working that through to those sort of cascading impacts that fall out of say one risk, and you can have multiple impacts and then multiple different financial impacts. So that brings with it a high degree of uncertainty. It also is very sensitive to the assumptions that you're making. So there's a need to have a clear connection here between any work going on with the sort of financial impacts hat on versus the earlier risks, opportunities and impacts work. So we have sort of, through the standard more generally, and in the way we designed the adoption provisions, which is to give effectively an extra year's grace for these financial impacts disclosures, is start qualitatively, build in the quantification over time. Don't leap to the highly quantitative approach, because you can drown in the sort of pursuit of perfection and just the difficulty of dealing with some of the data in this area, given it's so new and novel. And so that's been our approach in general. There is, however, a requirement to disclose quantitative financial impacts, and so that means that you're going to have to make judgments about the appropriate way to do that, which is why there's so much increasing interest in this area. So this is an excerpt from our guidance, which is to provide some examples of where you need to have in mind the principles that we have in our third standard, NZCS3, one of which is around coherence, but effectively the key point being that you need to be telling as clear a story as possible to your primary users, and to be making sure that that story is coherent with your financial statements as well. And so there are different ways and examples here about how you can either cross-refer to financial statements, or you can provide additional information in the financial statements as well. And last point from me before I hand back over to the team is to really take care when you're judging whether to quantify. Keep in mind the requirements in NZCS3, which is that you do need to disclose underlying methodologies, assumptions, and uncertainties. And in general, because of the much higher degree of uncertainty that is involved with looking out as far as 2050 or 2100, we all have to get better at actually communicating uncertainty. And it's a challenging area, but it's also very doable, and it's important because we need to open ourselves up to consider what it is that we're uncertain about and what it is that we are more certain about. So just to recap very briefly, don't forget the why. Start qualitatively and take care when you do choose to quantify. And that's all from me for now. Thanks, everyone.
Great. Thanks, Jack. Thanks, Bridge. So we've taken you through today at a high, simple level how you actually get to those financial impacts and how you end up actually putting a dollar or a euro or a yen symbol next to a number or a range in an organization's public disclosure. Some of the things that I want you to really think about now are that you absolutely can do this. Putting dollars next to climate-related financial impacts isn't going to be easy, but I hope we've shown that the approach to financial impacts, at least at a high level, is surprisingly straightforward. You really should be doing this, and you should be doing it internally. As Bridge mentioned, you can't just outsource this to a consultant like WSP or like anyone else. Your people inside your organization who understand the operational, the actual financial impacts better than a consultant by virtue of being within them, they need to be very involved. Your finance team needs to be really involved in developing the climate-related financial metrics with your leadership, with your organization's personnel. And you can get outside expertise to help upskill you and build your internal capacity. That's something that we do with clients a lot. And of course, you'll also need assurance, particularly at least in New Zealand, on the greenhouse gas emissions reporting, and I would suggest eventually on the entire thing. You can and should make judgment calls to cover what the kind of climate scenarios and the financial models can't. Tipping points aren't reflected in the climate scenarios that are most widely used, such as the Network for Greening the Financial System and GFS scenarios. There was a report on the UK Institute of Actuaries about that recently. But that's why you have that qualitative judgment. I mean, the people who are in charge of your organization and can make those judgment calls, they're there for a reason. They need to be empowered to do that. And lastly, quantifying these financial impacts will lead to action. We're at the point where governments are happy to declare climate emergencies, but aren't necessarily able or willing to pay for that emergency response. But this is how we decarbonize. This is how we transition to that lower carbon, eventually net zero or negative carbon economy, a more resilient economy and planet. And that's consistent with New Zealand's and just about every other country's commitments under the International Paris Agreement to limit global warming to at most well below 2 degrees C and aspirationally to 1.5 degrees C. And with that, I think we'll move on to questions, which we have plenty of time for.
Yeah, great. We are on time, so we've got about 15 minutes of questions now, and I will read them out, and between the three of us, we'll try to answer them as best as possible. So the first one that's come through is, how are you approaching high impact, low probability events that are often not accounted for in existing models? Matt,
I could take that one. Yeah. So, I mean, right now it is largely qualitatively or quantitatively outside of the models. A model is just a simplified representation of a real world system, and emphasis on simplified there. It can't cover everything. So that's where that ability to make some judgment calls around it can come in. I mean, organizations should be doing this in other contexts, right? Like here in New Zealand, we have incredible potential exposure to seismic risk because we're on the intersection of the Australasian Plate and the Pacific Plate. It would not be acceptable for any organization to just completely ignore that risk and disregard and not plan for it in any way. such as minimally just having insurance for your assets. That's something every homeowner obviously has to do in a place like Wellington that is earthquake prone. So you think about this in similar contexts where there is that high impact, low probability event. Maybe it's a financial crisis, and how you're planning for that within your financial impact methodology.
Cool, thank you. I'll move on to the next one. And the next one is, how accurate can we expect climate costs be? I can probably tackle that one. So I think with financial costs, obviously they're going to be a broad range, and you're going to use orders of magnitude. And yes, they might not be right, but we're not trying to absolutely predict the future and get it absolutely correct, because we don't know how the future is going to play out. It's a judgment call at the end of the day, and really it's you show your math and your working and your assumptions that are wrapped up into it. I think it's also important to keep in mind that investors shouldn't really just be looking at the figures that you're disclosing. What they should be looking at is your transition plan in response to those figures that have come out, those financial impacts. If you're transitioning and you're putting capital allocation behind all of that, then they should still have confidence in your company. Does anyone else want to add anything? Otherwise, I'll jump on to the next one. So the next one is, how likely is it that the AASB will adopt ISSB standards for reporting? That's
More
probably
acronyms.
A good one for you. Yeah, Jack.
Sure, yes. The AASB, I believe, is talking about the Australian Accounting Standards Board. So lots of interest in New Zealand at the moment around, the AASB kind of catching up with New Zealand leadership in this area. So they're basically, as far as I'm aware, currently working through the ISSB, so which sits under the IFRS Foundation Matt talked about before, who recently put out the global baseline climate and sustainability standards. So in Australia, they're working through effectively that as a starting point for a draft climate statement, draft climate standard that they will then go and consult the Australian affected entities and stakeholders about. So that's that is how the ISSB standards are intended to roll out globally, is that they become the base, but everything here is all drawing off the TCFD as the kind of core base. So I think everyone gets a bit excited about international alignment, but everyone's drawing on the same source material, so there's a lot of similarity that's expected to come out the other end.
Cool. And the next one is, how do you foresee public and private sector disclosure requirements evolving now that the IFRS has been released?
Yeah, I can start on that one again. I mean, so with what the Australians are looking at, they're looking at going quite fast on public sector reporting on climate change as well at the same time. Matt mentioned some of the public sector requirements that were put together and implemented through the Zero Carbon Act in New Zealand. So I think together with jurisdictions now also moving on the public sector, there's action from the International Public Sector Accounting Standards Board, who are setting standards as well at the moment around climate, that we're going to see more and more action on the and momentum on public sector reporting, and also more convergence across the bridge or across the divide between public and private sector that probably exists right now, where there's I think the public sector has had some requirements for a while, but these new climate standards that are hitting are probably upping the bar a bit on that. And so now I think there's the game for the public sector to catch up with where the private sector is getting to.
And if I can just add one thing on that, like even if you're not one of those, in New Zealand, one of those public sector organizations, and there's 600 plus of them, and lifeline utilities that are captured by that Zero Carbon Act reporting obligation, which is aligned with the TCFD framework, or if you're not one of the 200 or so organizations that's captured by the amended legislation to require reporting from the financial system across New Zealand, even if you're not there, you're still dealing with banks and insurers and customers who may be needing to do that kind of reporting. And somebody's scope 1 and scope 2 emissions is somebody else's scope 3 potentially. So like, you want to be thinking about how you can prepare yourself, because this is just where all financial reporting on climate related risks and opportunities is going. So there's going to be a ripple effect as this spreads throughout the financial system, not just in New Zealand, but globally. Although Jack's been very humble. We were the first country to pass that legislation, and we're very proud of what we've done so far.
Cool, I'll move on to the next one. How can we overcome the limitations of the models that don't include tipping points? Is it wise to use these qualitatively?
Yeah, I mean, I think I kind of got to some of that when I was talking about the high impact, low probability events. But and as that UK Institute of Actuaries reports on these international scenarios that most of the central banks are using, and then a lot of private sector banks are using as well, pointed out that they don't really consider tipping points at all in those scenarios, and project at least under some of the scenarios, potentially not very plausible levels of GDP growth globally. You do then need to kind of take that analysis outside of those scenarios and outside of your existing financial models for now, and make some of those judgment calls. And there will be improvement in the scenarios. There will be improvement in financial models to better capture this, but and there's improvement in the scientist models about how to better capture this. Those things will increasingly be aligned, but for right now, you do need to make some judgment calls, I think, outside of just using the models. And as long as you can justify where and how you're making those judgment calls in your financial reporting, you'll probably be in good shape. It's about transparently explaining, so your investors will then make the decision about whether or not they think that you're handling it appropriately.
Can I just add one point on that, which is I think that, in addition to the scientific tipping points that, some I think first comes to mind for people in terms of physical climate impacts sort of passing critical tipping points leading to further and more accelerated climate change, there's also increasingly, I think, on the transition side, an understanding that the socioeconomic tipping points are also potentially in the similar way being underestimated in models, because models in general tend to be more based in a kind of an equilibrium worldview when it comes to at least the way that the economy works, and that therefore it's not just the physical climate tipping point side that are potentially underestimated, but also the social, which is also good news, because society and the economies around the world can potentially move much faster than we tend to assume in a lot of the existing climate scenarios, and so would recommend that as people start to think about improving the how tipping points are reflected, don't just think about the physical, but also the social and economic, and the fact that if things line up globally, the transition to a low emissions economy could really move really fast.
Absolutely.
So next question we've got here is, how will Maturanga Māori, kaupapa Māori shape our reporting frameworks for iwi entities or those engaging with iwi entities? So I can probably tackle that one first, but Jack, you've got some work at the XRB that's happening in that space as well. But I think it's just important to acknowledge this is absolutely like a Western framework, a Western approach to doing this. It has come out of North America, and I do think that there's a lot of work that needs to be done to bring a Māori lens to this, and an Indigenous lens to it as well. But I do believe that if you are bringing that lens into your work, it will absolutely benefit your transition, to a low carbon economy. If you're bringing Maturanga Māori into your governance, the flow out of that, of the decision making, is really going to make good decisions and more holistic decisions, really, as well. So yeah, that's it from me. I'll throw to you, Jack, because you've got some work happening in this space.
Yeah, thanks, Bridge. I mean, I think it's a great point on the, even when you're thinking specifically about this regime, not to overlook the potential for partnering appropriately and trying to work with Māori to, bring Māori knowledge to the table. That's harder at an entity level, and it's probably more workable if you can collaborate at a bigger scale. So that's where we've been encouraging entities to get together in sectors at least to do climate related scenario analysis together, but that can take other forms in terms of regionally as well. And I guess thinking about John Reid, a researcher down here at the Ngāi Research Centre, who's done work around Christchurch as a region and the potential physical climate impacts, and a Māori perspective at that risk assessment stage can be incredibly insightful as well, not just at the transition planning stage. So, becomes a challenge to actually make that happen in practice for you, but, encourage people to think about it. And then, in parallel to these mandatory climate standards at the External Reporting Board, we've also got another project on, which is a voluntary framework that we're developing with Māori entities, which is called Aotearoa, where we're trying to effectively centre a Te Ao Māori approach, and starting with basically a series of wānanga with Māori entities to ask them how they report, and trying to distill the common elements into a framework that can be used more broadly among Māori entities. So if people are interested in that project, then please reach out to me or the team to learn more.
Okay,
Rich, we have so many questions. Should we maybe go for one more and then we can just end a few minutes after?
Well, the next one's potentially a short one. It said, are there globally accepted methodologies for quantifying? Short answer is no. But is there any more to answer to that, to add on to that?
I think I'd just add that it's important to try and take a horses for courses approach with this in terms of the right method for the right job, and that might not be one method for your whole entity, and it might be different methods for different risks.
Okay, great. Well, before we kind of run well over time, I might just finish it off there. There are so many other questions on there. Thank you for submitting them. Sorry we couldn't get to them, but you can see our contact details up on the screen, so please do reach out to us. Happy to have a chat about it. Yeah, we can absolutely talk you through more of those questions that you have. Anything else to add, Matt or Jack? Otherwise, I might just close us with a karakia.
Just thanks very much. Hopefully this has given a lot of people the encouragement to get started on this, because it is really important. And the market is going to ultimately decide what good reporting looks like and what it doesn't. So the sooner you can get started on this, the better off you'll be.
Yep. Thanks, everyone. Thank you for having me, team. And I guess I'd just reiterate the message that don't forget the why as well when you're starting to do this work. Keep that in mind as well.
Amazing. So I'll just close us off with a karakia. Kia whakarere, te tapu, kia wātea a te ara, kia tukiri whakataha ai, kia tukiri whakataha ai, haumie, huie, taikie. Thank you everyone for joining, and you can download our slides if you want them in the handout box, and this will also be recorded.